make with RBI or any other bank as well as financial institution, any of the FD or any such account which are made with those banks or financial institutions, or interests are paid by them. So that's type of it. Or other type of interest income which are possible where the bank interest earns the interest. Okay. Non-interest income means other than interest income, any other income which is received by the bank, they will fall under this other income category. That like commissions, exchanges, brokerage, the rent received from the STV lockers, profit on sales of any securities or any type of investments, or profit on sale of land, buildings, and any other assets by the bank, or profit earned by the bank on foreign exchange transaction. So, or any other miscellaneous income like go down rents received, or income from bank's property which is given on rent, or any security charges or insurance, or all other things will fall under this other income. So incomes would be two types: interest income and non-interest income. Basically, interest income is always more than the non-interest income, because here the earning is most part of the earning of the bank comes in the form of interest. Okay, so that is about the income. Now, if you go to the interest expenses, so accordingly we have interest payment as well as other expenses, and sometimes some provisions and some contingencies are also spent by the bank. So interest paid means normally we pay interest on the deposit as well as some borrowings. If we borrow from the market, then interest will be paid for them. So interest on deposit, interest on borrowing from RBI or any other financial institution or bank, or other interests which are paid as a discount or interest on borrowing, or refinances received from the financial institutions. So any other interest which is payable on banking activities, they will be falling under this interest paid. Then operating expenses. Operating expenses, to run the business of the banking, we have to spend a lot of money. So basically payment or salaries to the employees, or any provision for the employees, that is the major part of expenses under the operating expenses. Then rents are paid, taxes are paid, lighting we pay, water charges paid, printing and stationery charges, banks pay for advertising and publicity. Then depreciation on the bank's property are done every year. Then the fees paid to the directors or auditors, or any allowances or expenses, traveling allowances, legal charges are paid for legal battle we encounter with. Then we pay for courier charges, postages, insurance payments, insurance premiums are paid. Then for repair and maintenance, other charges are everywhere, recurring expenses have been made. Any type of donations are made by the bank, or any type of subscription for magazines, newspapers, periodicals are done, entertainment expenses and travel expenses. So all this will come under operating expenses. Provision and contingency means any kind of provisions bank is making. Mainly provisions are made for, say, bad debts, say NPA provision. So that is a major part. NPA, for NPA, we have to make provision. So provision for bad debt is this NPA. Or provision for any taxes has been made. Tax provision we make. Or any of the investments which are, say, there is a depreciation in the value, to cover that, provisions are made for those things. And these are provisions, or we can call that contingencies. So emergency, we have to make some provision for that. So that will fall under this provisions and contingencies. So these are basically the income and expenses of the bank. So we have covered the profit and loss as well as balance sheet. So we know what are the items in the balance sheet and what are the items in the profit and loss. So basically, balance sheet, whatever the items are there, liabilities are the funds we receive to do the business, which are used as assets. So liabilities become assets. So basically, either we lend or we invest. So lending or investment, these are the two basic things where we learn. Other than that, also so many other things are there which bank enters into to earn the income. So by using the liabilities, we create asset, and through this we earn. So earning is done. So that will be expressed in the P&L. So at the end of the year, if there is surplus, we have profit. If there is a deficit, then there will be a loss. So this is the basic process. So to earn, we have to manage this entire liability and assets. So this asset and liability has to be managed effectively to earn more and more. Every time our goal is to earn more and more, so that our profit should be also growing every year. If that does not happen, then definitely we are at a problem. There is some issue because profit has to be earned by the bank to sustain in the way, to remain in the business. And from profit, we have to build our capital to make the bank strong enough so that in case of any bankruptcy or any failure, we can easily cover that. So that is the process. Okay. So now we'll go to a little bit of something which is also part of this question, which is sometimes numerical comes. After that, we enter into asset liability management, how to manage the asset and liability. That we'll do. So first we'll go for those simple two things where normally questions are asked to maintenance of CRR, cash reserve ratio. How this cash reserve ratio is maintained? What is the calculation? So basically, why I'm going to explain this, because sometimes one numerical will come. One numerical will come. So you have to answer those questions. How this CRR is calculated, how much CRR is needed. So that thing we'll just cover. After that, I'll go into the asset liability management, which is a part of balance sheet management. Okay. So carefully listen to how this CRR is calculated. So CRR or SLR, both are same, but normally questions is asked for calculation of CRR only. SLR will not come into question. So we'll discuss about that. So what is CRR we know. CRR is cash reserve ratio. So a certain percentage of our NDTL or DTL, whatever you call, say DTL or NDTL. So certain percentage of that amount of NDTL has to be maintained in cash with RBI. So this is the basics. You say, suppose this is 4%. So 4% of NDTL has to be maintained with RBI in the form of cash. So what are those things? What are those things? How to arrive at this DTL or NDTL? So which are the things which are included in those things, or we can say that which are the components of those DTL or NDTL to be taken into consideration to calculate CRR. So first we should learn what are these components. Before that, I will tell what is the NDTL. So we know that DTL is demand and time liability. DTL is demand and time liability. So demand liability and time liability means all the demand liability and all the time liability. So basically we know that demand liability we have already discussed earlier. Demand liabilities are savings account, current account, overdue deposits. There's so many things we have discussed. Then time liabilities are the fixed deposit or recurring deposit. And other liabilities are also there in this demand and time liability, which are in the form of demand liability. Okay. So from this demand liability, we have to calculate the net demand and time liability. So what is this net demand liability? Net demand liability equal to total demand and time liability plus other demand and time liability, if that is there, any type of other than deposits and everything, any other thing is available, they are called other demand and time liability, plus liabilities to others. Others means other than public. These are for public. So it is liability to others. So this is you have to take. We have to reduce it. An item called assets with the banking system has to be deducted. Assets with the banking system. So DTL, we know what is DTL. Now this, what is liability to others? I'll just tell you. Other detail mean other demand liability also. We know that some other things are available which are not as deposit or fixed deposit or savings deposit, but they are in the nature of demand liability or time liability. So they will be falling under the other type. Now what is this liability to others? Liability to others means basically these are the liability. Liability means we are going to pay to somebody else. So it is not our money. So basically liability to others means money at call or short notice.
Sir, kindly tell me that DTL, sir, network issue, sir.
DTL is demand liability and time liability. Demand liability is savings account, current account, overdue deposits, so other things are there. They are called demand liability. Time liability or FD and RD. So they are called demand liability and time liability. Okay. So now liability to others are money at call and or money at short notice. Money at call means it is overnight. Short notice means up to 14 days from outside the banking system which the bank has taken. Or the loans and borrowing from abroad by banks in India. If our bank in India have taken any kind of loan or borrowed something from abroad, that will be also liabilities to other. Okay, so that is to be added. Then assets with the banking system will be deducted. Now, what is this assets with the banking system? Basically, that means any balances. Suppose my bank is maintaining some balances or some accounts with other bank, balances with other bank. Say in a current account or other bank or any financial institution, so any current account is maintained or any fixed deposit is maintained or funds which are maintained with some of the financial institution by the bank. Okay, so basically those are the things which are called assets with the banking system. Because when my bank is maintaining one account with other bank, anybody asking any question?
Yes, does it include balance in the nostro account?
Balance is in?
Like the account we are maintaining
any balance you maintain with other banks in current account. So balance means your money is that. So it may be your domestic account or anywhere you maintain that current. So nostro account is also a current account. So any account which is current account in nature, which is maintained by your bank in other bank or financial institution. Okay, so those are the assets with the bankings, because these will be represented in the asset side of the bank's balance sheet. So these things, if they are there, then that thing has to be reduced. So by applying this formula, we arrive at NDTL.
Sir, other detail?
Other detail means which are not savings and current account, but it might be like say margin. You are holding some of the margin money. You keep it for issuing some bank guarantee or LC, or any of the balances which are in overdue time deposits, or overseas borrowings are there. So there, overseas borrowing is there for you. So those are other demand liabilities or liability to others. So they are not in pure nature of demand and time liability, like a savings account or current account or FD account from public or RD account from public. But these are for other people. These liabilities are on behalf of other people, not for the public.
Sir, subsidy हो सकता है?
सब्सिडी
जीरो इंटरेस्ट पे फ्री
सब्सिडी जो मिलता है सर
subsidy you received for adjustment with for the loan account. If you are not
yes.
adjusting those, suppose subsidy normally they come, you normally some of the subsidy immediately adjusted, some of the subsidy you keep it as a fixed deposit at the end of the maturing of the loan or at the time of say squaring up the loan.
3 years or 5 years like that.
So whatever
Yes,
it means,
sir.
suppose those things are kept, so they will be falling under other DTL.
Okay, sir. Okay.
Okay, because they are not from the public. We are not received them from the public.
Yes,
Or sometimes some unclaimed deposits are there.
yes, sir.
Some credit balances.
RBI, sir.
Pardon?
Unclaimed will go to RBI, no?
When it will go to RBI?
Up to 10 years. After 10 years, sir.
So
Good.
till 10 years,
Demat
till 10 years, where it will be kept? Till 10 years, you will. So then where it will be? Till 10 years, it will be there, na?
Yes, sir. Yes, sir.
जो आपके पॉकेट में है तभी दिखाओगे, नहीं है तो क्यों दिखाओगे? Till it is in your pocket, you have to show it, na?
Yes.
So savings account, suppose somebody withdraws, so what will happen? Can you show that amount? Current account, if somebody withdraws, then you show that account?
No.
So unclaimed deposit till it is with you, savings account till with you, current account till with you, FD till with you, RD till with you. Till the time you are maintaining those things, you have to show. Whether you give it to customer or RBI or somebody, that doesn't matter. So those are the other time liabilities. Is it okay? Now, so components of DTL, I'll just tell you what are the DTL. So we know that savings account, current account, any of the credit balance in the CC or OD account, that will also come. And any of, say, second thing, other DTL, everything, say, I told you margin held in for LCs, issuance of LC, bank guarantee, or any type of overdue time deposit which are matured but had not been paid yet or renewed. So here it will come, all types of FD and RDs will come in DTL. Then overseas borrowing will come. Overseas borrowing means you have borrowed from outside. Any of the foreign outward remittance you have sent which are in transit, means you have sent but it has not reached the point, so it is in the pipeline. And other demand and time liability is told to accrued interest. You are keeping accrued interest which has not been paid yet, but you are keeping in your account. Then any credit balance you are you have set aside in suspense account to be adjusted. Then you have outstanding in your demand draft account. So demand draft can be issued, but it has not been paid. So those are the outstanding in demand draft account. Then you have unclaimed deposits, or you have deposit held. Suppose some of the deposit you are holding as security for loans and advances, which are payable on demand. Or sometimes unpaid dividends are account is maintained. Dividend you have declared but it is still not paid. So those will be there. So these are the basically your DTL. So all these things are going to be paid to somebody. So they are the components of DTL.
Sir, the LC and BG is also a DTL. And it is also in other DTL.
LC and B, see, I told you margin held on LC or BG. Suppose you are issuing LC or BG to any of the customer, and against this you have asked for security where the customer has given you some kind of FD or current deposit. So these are the DTL. LC and BG are not DTL. LC and BG are non-funded thing. While explaining, I told that margin held against LC and BG. It is not LC and BG.
Okay, sir.
these are the security which are held against LC and BG for issuance of LC and BG. Normally, bank guarantee you issue by accepting 100% of FD. So that FD is margin held against bank guarantee. Okay. Now, some exemptions are there. So, which are exempted or which should not be taken into consideration for CRR. So, basically, first is say liabilities to the banking system. Means any liability, say anything you have taken from other banks. So, that is called liabilities to banking system. When liability to public, that will be taken into consideration. But liability to the banking system will not be considered. Means, which are the things liability to the banking system means? Banking system means I am telling you liability to the domestic banking system. What type of things will come here? Liabilities to banking system?
Call money.
Huh? Call money. Call money what? Call money is two types. One call money you borrow, one call money you can lend. Which one will come here?
Borrowings.
Borrowing. Okay, fine. So domestic borrowings will come into picture. Other than that,
sundry deposits, sundry credits.
Account of other
Finance taken from NABARD.
finance taken. Very good. So any of the refinance you get either from NABARD or RB or
Finance from NABARD and kitty.
or any other bank account you maintain for other bank. Their money with you. Any other bank comes to you to maintain a current account or a FD with you. So that is means liability to our bank, but it belongs to another banking system, not to the public. So borrowings, refinance from any other bank or RBI, NABARD or Exim Bank, whatever refinance you get, or any other bank account you are maintaining on behalf of any other banking system in India. So that is to be excluded. These are exemption or exclusion. Okay. Similarly, sometimes some banks participate in the Asian Clearing Union. Not domestic, it is Asian clearing system is there where banks have to maintain one account which are called account in Asian Clearing Union. So basically if there is any credit balance in the Asian Clearing Union account, which is a dollar account, US dollar account, that will not to be taken into consideration. Similarly, any demand and time liability which are held in your offshore banking units. It is not in India, but they are in offshore banking, your bank's offshore banking units. So they are not to be calculated as DTL. Fourth is we maintain FCNRB account. FCNRB account. So in FCNR account, FCNRB account, eligible amount for the incremental FCNRB or NRA deposit of maturities of 3 years and above. Incremental part, not the first part. It will be incremental part only, not to be included. So basically these are the, if such items are there, so you have to exclude this one. Okay. So this is what the
Fourth point, sir. FCNR B1.
say amount of incremental part of FCNRB and NRA deposits with which have maturities of more than 3 years and above. That means suppose you have received one FCNR or say NRE deposit on behalf of the bank on your customer, which are maturities are more either 3 year or more than 3 year. Say you have received say $100. So what happens? Today you have received $100. So dollar rate was say 75 rupees. Okay. Now after some time, what happens? So after say 1 year or 2 year period or 3 year period, you calculate when the dollar is increased to say 82 rupees or 81 rupees. So what happens? Normally this value increases due to the increase of these things, the rate of rupee or dollar. So that means you have received at 75, but now it has become 82. So those FCNRB NRE account which are more than 3 years or equal to 3 years maturity only, not below that. So those things, whatever the incremental value is there, that should be excluded. Is it clear?
Yes, sir.
Now this CRR balance, whatever thing is there. So one list is there. I will give you that list, or it is also there in the book also. You can read that, which are the things to be taken into consideration, which are the things to be excluded for calculation of CRR. Okay, that so normal questions will come on those type of things. So we'll discuss 2-3 questions so that it will be easier to understand it. So whatever things I've told you about the exemptions, normally this Asian clearing account, the offshore banking unit, they are not asked in the examination normally. But I have told you what are the things which are exempted. It is there in the book also. You can read that. Now, this CRR, as per RBI specification, it has to be calculated at a fortnight interval. This is calculated fortnightly. And fortnightly means here it is 14 days, not 15 days. So basically from Monday to Saturday, you take 7 days, 14 days. So fortnightly means one Friday to another, say Friday, one Friday it will start. Normally it starts from a Friday and ends with another Friday. Friday, in between also on Friday. So only 14 days calculation has to be done. So DTL balance at the end of previous fortnight is taken. So basically suppose Friday was, say today is Monday 11th. So Monday is, today is 10th. Say Sunday was 9th. Saturday was 8th, say 7th. 7th of October was Friday. Okay. Now next Friday will be 21st of October.
21st.
So after 14 days means the next Friday where the 14 days will end is 21st October. Okay. So we have to take that 7th October to 21st October is the range where the CRR has to maintain. And this has to be maintained on the that NDTL or DTL of this Friday. 7th October DTL balance we have to take. So whatever the balance of 7th October DTL and NDTL we are taking, and if it is 4%, that means that 4% has to be carried on. Say 100 rupees was your NDTL or DTL, whatever you are asked to take that thing, say DTL 100 rupees. So 4% is the balance you have to maintain as a daily balance to be maintained in the form of cash with RBI. That means every day from 7th, 8th, 9th, 10th, 11th, 12th, like that, 21st, your everyday balance should be 4 rupees of cash you have to maintain. That means 4 rupees for 14 days you are maintaining. So if you take the product of 14 days, so 14 into 4 means 56 is your product balance. This is called product balance. Every day you are maintaining 4 rupees for 14 days. So you can take that for 14 days, your product balance becomes 56. Is it clear? Is this example is clear? Then I'll go ahead.
Yes, sir.
Okay. Sometimes what happens, sometimes it is difficult for a bank to maintain that 4 every day. That means 4% of the DTL is not. So RBI has relaxed a bit. Now RBI says that you can maintain 90%. 90% on any day. 90% of your this whatever the daily one. This is called average daily balance. That is the average daily balance you maintain 4 rupees. But 4 rupees might be higher thing for some banks. So RBI is told that any of the day you can maintain 90. 90% of the average daily balance. But at the end of 14 days, the product's balance should be 56. Is it clear? That means any day you can make 3.
90% of sir, 90% what for? Or
90% of it, average daily balance, which is 4 only. Average, I told you, this is the average daily balance. So you have to, suppose 100 rupees your DTL, 4% is your CRR to be maintained every day. So 4 rupees is the average daily balance. Okay, so that has to be maintained for 14 days, so 56. Now RBI has relaxed it. RBI says you can maintain up to 90%, not 100% of 4. 90% you can maintain of this average daily balance. And so 90% means how much? So 3.60 you can maintain any days. But when you take the product balance, it should be 56. It should not be less than 56. That means other days you have to maintain more than 4 also. Otherwise the 56 will not come. Yes or no?
Yes, sir.
Okay, fine. Is it clear?
Sir, in treasury management, you said that you are maintaining for this Friday, first day of Friday, no? They said previous 2 means cycle, you have to maintain previous 2 cycles balance.
That is for SLR.
Okay, okay.
Because treasury is worried about SLR, where cash is not maintained. For cash, it is 1 fortnight. For SLR, you go back to second fortnight. To go back another week. Okay. So in case of SLR, it is 2 fortnight lag. So that is called 2 fortnight lag. 2 fortnight lag. For CRR, it is 1 fortnight lag. Okay.
Yes.
So your question will come for CRR. Is it clear? Everybody understood this concept?
Yes, sir. Yes, sir.
Okay.
Yes, sir. Yes, sir.
Okay, fine.
Please mute.
Okay, SLR is also same type. Only difference is that exemptions allowed under CRR are not available for SLR calculation. So SLR, there is no such exemption which I have told you. Otherwise, the components are same. Okay, and we know that SLR is maintained along with cash balance. It can be with gold as well as approved securities, like government securities, including treasury bills. So that is the only difference, nothing else. But questions will be asked for CRR only. So you have to. So what are these approved securities? Can you tell me? I have already explained to you. What are these approved securities which are coming under SLR?
Treasury bills.
Okay, treasury bills.
Government securities.
Government securities.
So they are normally called dated securities. Okay, dated G6. Dated G6 because they are dated, means they have a fixed maturity period. That's why they are called dated G securities or G6 government securities, which may be from state government or central government, both. Okay, so these are basically they are part of this SLR. Other than also a lot of instruments, sometimes RBI prescribes, sometimes state development loans of any state government issued under market borrowing program. So many things are there. So those things are basically, you should understand that this approved security means normally treasury bills or dated securities of government. Okay. Now, which are the liabilities which are excluded? This is the list I have taken from the Macmillan book only. So if you go to Macmillan book, read this, the same list is there. So only remember what are the things here. So paid up capital is not part of the calculation. Reserve is not part. Suppose questions will be given with some items like this: paid up capital, reserve, credit balance. So all the things will be given. You have to exclude those things and only take those things which are eligible. So paid up capital, if it is given, you have to exclude. Reserve is not part of this. Profit and loss is not part of this, means credit balance. Amount of loan taken from RBI and the amount of refinance obtained from any of the bank like RBI, NSB or NABARD, SIDBI, Exim Bank. Income tax provision to be excluded. Amount received from DICGC. Amount received from ECGC or any kind of subsidy which you received. So those things are, you should remember, the subsidy, these are the things you can remember. These are not part of the calculation of CRR under DAPL. Okay. So basically questions are asked on few items only, which I will show you 2-3 questions so that it will be easier to understand. Okay. So you can go through this in the book, you find that one. First we'll see. First simple calculation I will do, then we'll go to what are the items. So here the question says your bank has maintained the following balance with RBI in its CRR account. How can I know the page number now? I have to go through search. You can search it in. See, it might be somewhere in the, I will let you know afterwards. So first case study we'll do. Your bank has maintained the following balance with RBI in its CRR account for the fortnight ended, say this is the, okay. So it says that for first to 10 days. So you know that it is maintained for 14 days. So first 10 days, minimum balance of 90% of the average balance is prescribed by RBI. So whatever the balance is coming, 90% is maintained for the first 10 days. 11th and 12th, 11th to 12th day. So 11th and 12th day, means on 11th as well as 12th day, 98 crore each. So balance on 11th and 12th day was 980. This is the average balance to maintain for the fortnight at 820 crore daily, average daily balance. This is the average daily balance to maintain for the fortnight is 820 crore. Okay. Now, first question is on product basis, what is the CRR balance for the fortnight to be maintained as CRR cash reserve ratio compliance? What is the product basis 14 days balance? What is the amount?
11,480.
Very good. So 820 crore is this is the daily average daily balance. So you multiply by 14, so it becomes 11,480. Okay. So that is the answer for question 1. Question 2, on product basis, what is the balance maintained by the bank during the first 10 days?
739.
First 10 days.
7380.
7380. Very good. 738 is the daily balance for 10 days. So it will be 7380. 90% of 820. 90% of 820 becomes how much? 90% of 820 becomes 738. 738 per day for 10 days. We have maintained that balance. So for 10 days it will be multiplied by 10. So 7380 is the answer for question 2. Third is on product basis, what is the balance maintained by the bank 11th and 12th day together?
1070 each. 2140.
Huh?
1764. 1764, sir.
11th and 12th day.
1960.
1960. Because here you see, here it is given on 11th, 12th day 980 crore. So 980 into 2, 1960 is the correct answer. Okay? On product basis, what balance would be maintained by the bank?
Hello.
9340.
So much of disturbance you are making. No? So what is the balance?
9340.
So basically,
9340.
very good. So 7380 for the first 10 days plus next 2 days 1960. So it becomes 9340. Okay. Now, what would be the minimum balance to be maintained by the bank on 13th and 14th day?
1070.
Huh?
1070.
2140.
Very good.
2140.
2140 is the answer.
1070 average.
1070 into 2.
Sir, please repeat second question, sir.
Second question. You read the question. You read the question, please.
Sir, on product basis, what is the balance maintained during the first 10 days of the fortnight?
Okay. So what is given first 10 days? You read this one also.
Sir, minimum balance of percent of the average balance as prescribed.
So what is the average balance given in the question? Every day. This is the question part. What is the average balance? Average daily balance given as what?
Average balance to be maintained for the fortnight is 820 crores.
So 820 is the daily average balance. Okay. Average daily balance I have written here. 820. So for first days, 90% of the average balance is maintained. So 90% of 820 is how much? 90% of 820 is how much? You have calculator, no?
738.
So 911.
738. So per day 738. So it is maintained for 10 days. So 10 days product balance will be how much?
7380.
Who has asked? He has answered it. You got it, na?
Yes, sir.
Okay.
So in
Fine.
question number 5, what would be the minimum balance to be maintained by the bank on 13th and 14th day to ensure compliance under it is daily balance they are asking or product they are asking? Both the
Okay.
put together they are asking.
So daily balance you have to, suppose it's a daily balance, then you have to divide it by 2. Product balance will be 2140. Okay.
Yep.
So suppose, so that question should be clear enough, but this is confusing question. So if it is asked what is the product balance, then it is the 2140. Means both days, 2 days together, it is 2140. If it is daily balance, then
1070.
minimum daily balance is 2140 divided by 2.
107. That's why we said 107.
1070, right?
Yeah.
How much?
1070.
Yes, sir.
Okay. So this will be the average daily balance on 13th as well as 14th. Product balance is 2140. Product balance we got it. Na? So product balance is 14 days 11480 and 12 days we have calculated 9340. So we can deduct this 9340 from 1140. So it is 2140. So 2 days product balance is 2140. So 1 day balance will be 1070. Is it clear?
Yes, sir.
Yes, sir.
Question number 3, sir.
So please previous screen, sir. This calculation screens are 2140.
What 2140? See, what is the balance maintained by a bank on 11th and 12th day? Here it is mentioned here, 11th, 12th day, here it is given that 980 crore each day maintained. So 2 days, what is the balance? 1 day balance is 980. So 2 days balance how much?
980 into 2.
How much it is?
1960.
Simple thing, you are not reading the question properly, I think. Now this 13 and 14 days, we have calculated 12 days product. 12 days product we have calculated on question 4. 12 days product was how much? 9340. 14 days product we have calculated for the first question first question you have calculated 14 days. That was 11,480. So when you deduct this 9340 from 11,480, so 2140 comes. This is for next last 2 days of the fortnight. That is 13 and 14 day. Is it clear now?
Yes, sir. Yes, sir.
See, you people are really totally wasting a lot of time. Simple calculation. When you focus, when I am telling, it is easier to grasp. If you are absent-minded, unnecessary times are wasted. Okay. Next question. Now you see, this is the type of question will come. So here, entire items are given. So capital, savings, deposit reserve, FD from bank, current deposit, FD public, borrowing. So these are the things given. Now you have to answer first thing. First question you read, what is the amount of liabilities that will not qualify for NDTL? Which are the items which will not qualify?
Refinance NABARD. Refinance NABARD.
Capital.
Okay.
Accrued interest.
FD banks.
FD banks.
Okay.
Banks.
Refinance.
NABARD.
Borrowing FI.
Yeah, borrowing FI, suppose this is borrowing which is we can say that this is outside borrowing. Suppose this outside borrowing.
Interest accrued.
Interest accrued?
Yes, sir.
How?
No, it has to be part of NDTL.
This is other demand liability. Na? Suspense account, interest accrued are other demand liability. So basically, if you say 1, 2, 3, 4, so these 4 are to be excluded. So what is the amount? Total amount comes
21,620. 21,620.
Disturbance.
21,6. Somebody's disturbance. This is not from my side. Okay, you please take care of those things. So this is the liabilities which are to be excluded. Now you have to find a what are the, this is excluded. This is the exclusion. Now find out what is the eligible. Eligible amount will be how much? Rest amount you calculate and tell me.
2,67,260.
2,67,260.
260.
So this is the eligible amount for calculation of CRR. Now find out amount of CRR at 5%. So simply multiply by 5%.
13.
So how much?
13,363. 13,363.
This is the average daily balance to be maintained by the bank for how many days?
14 days.
14 days.
Now second question is, what is the minimum balance to maintain in share account if the minimum requirement is 95% of the average fortnightly balance?
12,695.
12,695.
So 13,363 multiplied by 95%.
95%.
To 12,695.
695. 695.
So this is where the question might come. Easier question, 1 mark question will come like this. Okay.
Can you just tell about the borrowing FI, sir?
So I have told you this is suppose so this is outside borrowing. So borrowing from, so what was the thing I have told you? Borrowing should be considered or not? Which are to be excluded, I told you.
Yeah, only financial, I mean banking system.
So what is there in this thing?
Okay.
Amount of any loan taken from RBI and the amount refinance taken from Exim Bank, and these are to be excluded. Okay. It will be clear after you do 4-5 exercise. Now it will be clear. Okay. Now another case study you do. As per RBI instruction, your bank has to maintain average balance for a fortnight for CRR at 1,600. So always remember, I have forgotten, average daily balance. Average balance means average daily balance. Say at 1600. Your bank is allowed to maintain 80% of the average balance for the first day to 8th day. And from 9th to 12th day, your bank has maintained 2080. Is it clear? Question is clear? This is a presumption 80%. Okay, RBI rule is 90%. Here the question says that suppose you are allowed 80% for the first 8 days. Next, from 9th to 12th day, your bank is maintained 2080. Clear question? There is no doubt about the question.
Okay,
Can I
sir.
go ahead? Okay. Now,
Yes.
on product basis, what is the CRR balance for the fortnight to be kept?
Sir,
22,400.
22,400.
Okay, very good.
22,400.
10,400.
22,400.
On product basis, what balance must be maintained during the first 8 days?
10240.
040.
10240.
10240.
10,240.
So 80% of 1600 into 10, yes, into 8. Because first 8 days, 80% is meant to be maintained by your bank. So 80% of 1600 multiplied by 10. So 1280 into, so 1280 or how much? 1280 into 8. So it becomes 10,240. Clear? There is no confusion?
No.
Find the balance to...
First one, sir.
1280, sir.
First one, sir.
2018, sir. 2080, no?
Sir, question number 3, sir.
Question number 3, see, simple thing. 14 days period, what is with the max? 1600 daily you have to keep. For 14 days, how much you want to keep? Simple multiplication of daily average into 14 days. So that becomes 22,400.
Okay.
The same type of question it is there in the case study 1 I have told you. Why you are confusing yourself, I don't understand. So the second question is for first 8 days, 80% is maintained. So what is the 80% of 1600? 1280 or not?
1280.
Multiply it for 8 by 8. So whether it is 10,240 or not?
Yes, sir.
Then simple mathematics, simple multiplication. Now find the balance to be maintained for 9th to 12th day on product basis. So 9, 10, 11, 12. 8320. Okay, fine. 8320. Everybody is agreeing?
Yes, sir.
Yes, sir.
Yes, sir.
Sir, how
So pardon?
3840.
3840.
Which was in 3840?
Next
1340.
question. Next question.
Okay.
Number 6, sir. 3840. 3840.
Next one is 3840.
40.
Daily
3840.
1920. Daily
So
product.
3840. So here we'll find out the minimum balance required on 1340 days. So 3840 for 2 days.
2 days and 1920.
1920.
120 for 1 day.
Average.
1920.
Okay. Is it clear for? See, I am telling all the things because still people are confusing about things. Anybody has any doubt on this?
Sir, fifth one.
Question number 5, sir.
What is in the question written?
9 to 12.
So, what is the amount given here? 9 to 12? In
2080.
the question 2080, 9 to 12. 9 to 12, how many days?
4 days.
4 days. If you are keeping per day 2080 for 4 days, how much you have to keep?
Okay, sir. Into 4, sir.
Any other question?
No, sir. No, sir.
Now, sometimes this question will be asked, which is a little bit different than CRR. Say, a bank has deposit worth of 5 lakh crore. The interest rate on this paid by the bank is 10%. This is a deposit where bank is paying 10%. SLR to be maintained by the bank is say 20% on this deposit. What will be the effective cost to deposit? Can anybody tell what is this effective cost to deposit?
30%.
What is meant by effective cost to deposit?
Including
Cost?
that interest has to be paid by the bank and CRR, including that CRR.
So
You have to calculate excluding SLR.
12.5%.
1,50,000.
So who has told this 12.5%?
12.5%. 12.5%.
So how this 12.5% came to you? Can you
20%. No, 5 lakh may 20% will go into SLR. So balance 4 lakh.
Okay.
So 10% is 50,000. So this 50,000 divided by 4 lakh will give 12.25, so 12.5%.
Good, very good, excellent. So basically, what this effective cost to deposit means, see here, say 5 lakh crores deposits are there. So you cannot lend the full amount because here only says that SLR to be maintained. So 20% SLR to be maintained on this deposit. So 20% of 5 lakh crore is 1 lakh crore. That means 1 lakh crore you are not able to lend. So how much you can lend? Only 4 lakh crore you can lend. Now on this 5 lakh crore deposit you are paying 10% interest. So how much the interest you are paying? 50,000 crore. So this is the amount of interest you are paying. Now by lending 4 lakh crore, you have to earn this 50,000 crore. So that is called the effective cost to deposit. So that is a break-even point. Means here no profit, no loss. You have to earn that interest you are paying on the deposit from the lending of that fund. So only 4 lakh is allowed to be lent. So what will be the interest to be charged on 4 lakh crore to get a interest of 50,000 crore? So basically that means 4 lakh into R by 100. So it will be how much? Say 50,000 equal to 4 lakh into R by 100. So R equal to 12.5%. 12.5%. So 50,000 to be earned by applying interest of R from 4 lakh rupees. So you can simplify this R equal to 12.5%. So this type of questions might be asked. So you should remember how to solve the questions. Okay, clear?
Sir.
So,
Sir, yes.
yes or no?
Yes, sir.
Yes, sir.
Yes,
sir.
This I am leaving. Now we'll come to asset liability management to start with. So basically CRR calculation you can easily manage, and also this effective cost of deposit or cost to deposit you can do that. So 2 questions if you do, so 2 marks are assured for you. Now coming back to our parent thing, which is called asset liability management. So basically, as I told you, balance sheet management means balance sheet contains asset liability. So we are managing the balance sheet means we are doing the asset liability management. So basically there is a department called asset liability management department in each and every bank. It's like a treasury department, your risk management department. So asset liability management is a department which is a team of people. They are sitting to do this, managing this asset and liability for the purpose of enhancing your profit, or basically we can say that enhancing our NII. What is NII?
Net interest.
Net interest
income.
So net interest income means
Total interest earned minus total interest paid.
very good. So interest earned minus interest paid. Very good. So basically our purpose, the asset liability management purpose is to either increase this interest earning or decrease this interest paid. Either you earn this, suppose interest earning is much more than interest paid, then definitely NIA will increase. So basically our purpose is to increase the NIA. By whatever thing you manage this interest earning and interest paid, your aim is to increase the NIA. So this is what the asset liability management's main focus is. Okay, so this ALM department was previously not there in banks. Like risk management department was not there, asset liability management was not there. So after say 1990s only, this type of department came into picture. After this Basel came into picture, so it was considered that profit is a main thing, so we have to manage the asset and liability. Because if you go back to 1950s, 60s or 70s or till 80s, the banks were full of funds. Fund was not a problem for bank because that time lesser number of banks were there, no competition was there. People were totally coming to the bank to deposit their whatever their surplus was there. So there was abundance of funds in the bank in the form of demand and time deposit. So that time the liability management was not a problem for the bank because this was coming automatically. You don't have to go outside like you used to go today to tell people come and deposit. It was not necessary at all that time. At that time only bankers were sitting in the branches. People were coming from their own side. They were keeping that money. So liability management was not a problem till the 1990s. So banks were only focusing on asset management. Asset management is basically on the loan side. You give loan where maximum interest is earned so that you earn profit. That is the part which banks are doing till the late 80s or early 90s. So naturally, after what happened, gradually the availability of the fund became a problem from the bank. When a lot of banks came into picture, foreign banks came, private banks came up, new private banks entered the market. So what happened? Competition increased. So what happened? The low cost fund, availability of low cost fund started declining for the bank. Low cost fund means normally current account and saving account. So that term CASA came into picture in the late 90s. So everybody was worried about CASA. We have to improve our CASA because the availability of low cost fund gradually declined due to the competition. When this declined, now banks started focusing on the liability management also. Earlier asset management was done. Now due to this problem, liability management also came into. So asset liability management or ALM functions began to extend beyond the bank's treasury to cover the loan as well as the deposit funds. So both the loan side, investment side as well as the deposit side, all together it was decided that bank has to manage those things. Unless we manage both the sides, we cannot increase our profit or we cannot enhance our NII. So banks started focusing or concentrating more on the management of the both side of balance sheet to optimize the profit. Okay, so ALM models, some different ALM models have been devised to enable the bank to measure and monitor what are the risks in asset and liability are there, and how to manage the risk through risk management, and provide suitable strategies for the management so that the profit should be enhanced or NII should be increased. So that is the basis of asset liability management. Okay. So this is what I have basically told you. So in ALM, basically when you are talking about risks, basically we will be focusing on three types of risk in ALM. Credit risk, interest risk, and liquidity risk. These are the three risks which are taken into consideration out of all the risks available. These are the three major risks which are to be focused under asset liability management. So whatever the models which have been devised by the banks to manage this asset and liability, they actually have been introduced to measure and monitor these three risks: credit risk, interest rates, and liquidity risk. If you can manage these three, then we can easily manage the NII. So basic need is either you maintain the NII which is there for the bank last year, whatever NII is, you maintain at that level, or you increase that level. Suppose your NII was 10. So either for the next year you maintain in 10 or bring it to 12, 11, 12 or 14, 5, which is more than 10. So you should not be less than 10. That is the purpose. So basic purpose of asset liability management, I can say that either to enhance the NII or to maintain that level of NII for the future, not to reduce the NII. That is the entire focus of asset liability management. Okay. Now, as I told you, these are the different types of things, because earlier the interest rates were totally managed by regulator. RBI was dictating all the interest rate. Any type, deposit, loan, all the interest rates were decided by RBI. So I remember when I was working as a in the bank initially in those periods from say late 80s to up to late 90s. During that period, 10 or 15 years period, entire interest rates were given by RBI. So deposit interest, they will not change for say around 3 years period. Same rate of interest will be there. Advance rate also same thing. 2 years or 3 years it will change. For 2-3 years same kind of interest. There is no change, nothing. Now what has happened? Entire deregulation of the rate of interest has been happening. So RBI told that you have opened your shops, you are doing business, so you charge interest according to your business. I am giving you authority. You decide what kind of interest you are going to pay to the depositor and what is the rate of interest you will charge the loan. So you decide. I am not going to handle those things. So now you see that 99% of the interest rate for the banks, any type of deposit, everything is done by individual banks. Only few of their interest rates are still with RBI, like export rates. Export rate of interest. Are you with me or you are talking to somebody? Please, if you want to talk with your family member or somebody, please mute and talk it. Talk it out. There is no problem. If you stop talking, then I can talk. Because in the class, normally, one person if talks, then it is audible to everybody. So, normally, this export rate of interest or the minimum cap for savings rate of interest, DRI, advance interest, and interest on small loans given for agriculture, everything, the small loans up to 2 lakh. These are the few rate of interest which are still RBI is maintaining. RBI decides on that. Other than that, every interest rate is in the hand of individual bank. Okay, so every individual bank are doing this process of how to charge the interest. So basically, That means we have calculated that cost, say effective cost to deposit. So basically what means the fund is available 100 rupees and you are only allowed to lend or invest how much? Say if 18% is your SLR and 4% is CRR, that means 22 rupees you cannot lend at all. So how much is available? Say 78 is only available. So if you are paying 100 rupees, your average cost of deposit, suppose this is say 5%. That means to break even on 78, how much interest to be charged to get this 5%? 5 rupees has to be earned from 78. So definitely it should be more than say 7 or 8%. So if you are charging say 7.5% to get this 5 rupees, that means you are at break even. But you have to earn a profit also. That means you have to charge more than 75%. So you can charge 8% to earn a profit. So that is how you are going to manage. So here also thing is that the fund you have to manage, a 78 rupees fund is there. Your at hand 78 rupees fund is there. So this fund is not in a uniform, not kept with you for a uniform period, because some of the amount are in the form of savings deposit, some are current deposit, some are FD again for different maturity, 3 months, 6 months, 1 year, 3 year, 4 years. So different time bands are there, different time maturities are there. Similarly, the loan you are giving also same time. There also times are different. That means what? Ideally, if a 1 year deposit is available to you, if it is lent for a period of 1 year, say 1 year deposit, if you are paying say 5% rate of interest, and if this 1 year loan you are charging 8%. That means for 1 year, your net interest margin is, say, net interest income is 3%. That is constant. So ideal position is whenever the maturity of the fund available is equal to the maturity of the fund you have lent, then the ideal situation that maximum earning can be happening. Because suppose this fund is available for 1 year, but your loan is given for 3 years. Now, after 1 year, what will happen? What type of risk will be available there? What type of risk facing after 1 year?
Liquidity.
Liquidity or funding risk is there. Suppose this is not renewed. Again, for funding, you have to do that funding. Suppose you borrow from the market. In that case, this 5% may increase to 6%, also 1%. So that what will happen? It will reduce to 2. Suppose after 1 year period, deposit rate has increased or interest rate has decreased. Again, that will be impact on NI. So many factors are there. So those factors like change in interest, it might be change in exchange rates, or that might be credit is default in the loan, or it might be liquidity position. After maturity, fund is not available. So depending on these things, we have to manage this. So first thing is that we have to match the maturities. So matching the maturity is meant. It is difficult to match the maturity because nowadays you can see that suppose you take the example of your banks. So your banks, suppose total FD portfolio is 1,000 crore. Suppose total FD portfolio is 1,000 crore. In this FD portfolio, what is the maximum percentage of amount of FD as per the tenure? Can you tell me which time period of FD maximum constitutes the 100 crore? Total FD is 1,000 crore. So which is the tenure means time period? Which time period of FD will be the major contributor to this 1,000 crore?
2 to 3 years.
1 year.
Which bank is to Who told 2 to 3 years? Which bank this is? Whoever told 2 to 3 years, can you tell me your bank name?
I just guess, sir.
Then see, if you guess, then you will not get 50. I am telling you in the examination. Okay. Guessing is totally prohibited. If you are going to pass, no chance for guessing.
Okay.
Guessing will never lead you to pass the examination. Do not guess. Apply your. Bhagavan ne diya hai brain. You have been given a blessing with a brain. Just use that brain. If you don't use the brain, what is the purpose of brain? You tell me. You just don't guess. Please forget about guessing. Never guess anything. Okay. So basically, nowadays, as per the rate of interest structure in the banks, you will see that maximum rate available for 1 year period. So that means everybody coming to your bank, they are keeping their deposit for 1 year. So you can say, I can say that 70% of the total amount of 1,000 crore might be for 1 year period only. That means your deposits maximum amount is lying for a period of 1 year. Now when we talk about the loans, what is the maximum tenure you are giving?
30 years.
30 years.
Housing loan you are giving for a period of 30 years. So minimum can be, minimum I say 1 year and maximum 30 years. So if you take the average, taking into consideration all the types of loan, you will come to the conclusion that average period of the years, if you calculate all the loan according to this, it will be not less than 7 year period, 7 or 8 year period. That means average lending period is your 7 year, whereas the fund is available for 1 year. Is it a ideal situation? Ideal situation, I told you that 1 year is the ideal situation, but it is totally this, say we can call, there is a very great mismatch. Mismatch is huge. 1 year period availability of fund is there, but you are lending for a minimum period of 7 years. So this disparity is the main cause of reduction of NII profit. So now how to manage this? So that is what here. So we have to need to match the maturity. It is not possible to match the maturities of asset and liability in ideal condition, but it is possible to minimize the mismatches. Minimize, how much minimization of this difference of maturity can be done. The more you can minimize, more increase in the NII can happen. Do you understand the logic, what I am telling? What is the main objective of asset liability management? Is it clear to you what I have told you?
Yes.
Okay. So this is what the entire, when you manage all assets and all liability together, that management is called integrated balance sheet management. That is called integrated, means everything. Mr. Senthil Kumar, can you please mute Senthil Kumar? Mr. Senthil Kumar. Mr. Senthil Kumar, you are doing some business or what? This is a class going on. Do your business. If you want to do your business, you do it outside the class. Don't disturb your class. When all the things are taken into consideration, that management is called integrated balance sheet management. Okay, sometimes this question.
அது வந்து 100 ரூபாய் 3 கிலோ கொஞ்சம் தான் இருந்தது.
So this integrated balance sheet management concept has been involved. Okay. Now, what is the definition of asset liability management? Asset liability management means planning, acquiring, and directing the flow of funds. So we know the flow of fund. What is the flow of fund? Inflow is your. So again, I will ask, okay, if it is possible, you answer. So the flow of fund means inflow and outflow. Okay. Now, according to inflow outflow, can you tell me, when you are talking about the funds, what are the inflow funds?
Deposits.
Capital, liabilities,
Deposits and
Loan repayment.
loan repayment. Very good. Loan repayment.
The first
Then?
first 6 sources of funds is the inflow.
Borrowings are there?
Yes.
Yes, sir. Interest earned.
Commission.
Okay, well, I am talking about funds only now. Okay, now only fund. We are considering a fund only. I am not come to the income. So fund means basically we know that deposit is inflow, loan repayments are inflow, borrowing is inflow. Simple thing. So according to that, fund outflow will be loan disbursement. Okay, then
Closure of deposits.
huh?
Deposit. Closure of deposits.
Okay, payment of
Interest paid on
deposit.
deposit.
Interest I am not talking about. Funds I am asking. Only fund. I will come to that part.
Repayment of borrowings.
A repayment of borrowings. Repayment of borrowings. Okay.
Statutory payment.
Investment.
Investments. Very good. Investments. So basically these are the major things. So loan disbursement, payment of deposit, repayment of borrowings, and investments made by the bank. And these are the inflow. Now, according to fund, these are the things. Now, if we go to the income part, income and expenditure, again the changes. So inflow will be what? Loan interest. Loan interest will be the inflow.
Commission.
Then
Commission.
Non-interest income.
non-interest
Receivable.
Miscellaneous
non-interest. Miscellaneous. Say non-interest income is all income other than loan interest. Whatever is that non-income. So your interest or dividend from investments. Okay. So this will be the inflow. Outflow will be your deposit
Expenditure.
Deposit interest paid, borrowing interest paid. Okay, so this is, pardon? What charges?
Management and contingent charges.
Okay, whatever things. So these are the outflow. So just see, always remember this inflow and outflow are two types. One, when the funds are considered, inflow and outflow are different. When you are taking into income and expenditure, it is almost a reverse. These outflows income are coming from this side to become income, inflow, and this side interests are becoming this side. So it is reverse pattern. So inflow of funds and inflow of income and expenditure are totally different in nature. So you should not be confusing it. Later part when this topic will come, you should be always thinking that what are we discussing about, or what the question is pointing, whether the question is pointing about the inflow outflow of funds or it is about inflow outflow of income or expenditure. That way you have to segregate to find out the what is happening to NII. So that will come in the later part of discussion. Okay, so that's why I wanted to know that. Okay. So
Mute also.
Sir, can I mute everybody?
See, when I'm muting, they still see there is no decency in these people. How they managing their house and managing the banks, I don't understand. If they cannot be just keep the discipline for 1.5 hours, how in the life they are maintaining their discipline? I'm really surprised.
Because it is exceeding 50,000 limit. That is what is called a parameter.
Yes, I suggest you mute all so that after I finish, I can ask them questions.
Okay, sir. Okay.
Don't allow anybody to unmute.
Okay, sir. Okay.
Just few minutes, I can do that. Okay. So ALM.
Sir, you just unmute yours, sir, please. I did everybody now.
Okay. ALM is planning, acquiring, and directing the flow of funds through the organization. So I was talking about inflow and outflow of funds. Here funds is mentioned. So the flow of fund, how to plan, how to acquire fund, and how to direct that flow of the fund through the organization means to do the business in such a way or a proper way to maximize the profit. Already we discussed that maximization of the profit is the basic objective of asset liability management. So focus is on NII or NIM. Either it is net interest income or net interest margin. So either to protect means either to maintain at the same level or to increase the NII or NIM. That is the purpose of asset liability management. So this strategy of managing the composition and mix of asset and liability. So composition and mix of asset and liability. Composition mix in the sense I am telling. So composition of mix means we are talking about mix means both volume means quantity as well as tenure means period. So both mix means volume as well as tenure. Volume is the amount, quantity, amount, how much, and what time period, T, time period. So basically the strategy of actively managing the composition and mix of asset liability of asset and liabilities portfolios together is called balance sheet restructuring. So if the question comes, what do you mean by balance sheet restructuring? So you can say that it is the strategy of actively managing the composition and mix of asset and liabilities of a bank. So basically, what does that mean? That means main objective is to generate stable and adequate earning. Basically, our focus is on the earning. To generate stable and adequate earning and steadily increase the profit and build the organization's equity, or you can say build the capital, strengthen the capital over time by way of taking reasonable and measured business risk in our bank. Okay, so what is the thing to be done when you are talking about this asset liability management? So we have to look into three basic things. What types of assets and liabilities the bank is holding? What type of asset and liability banks is holding? Second is, what are their mix? Mix means volume and time, tenure. Volume of such financial asset and liability and time of or time duration or maturity of all this asset and liability. And if you can manage these two things properly, you have to have a clear understanding of this thing, clear understanding of what are those type of asset liability available to the bank or bank is holding and what is their mix. And you have to understand, apart from this, in which market area the bank is operating. What type of market condition is there? If you understand these three, then you can manage them effectively and do the justice to increase your NII. So that means balance sheet restructuring. Means we are restructuring the balance sheet items. Meaning we can adjust and readjust all the portfolios of asset and liabilities in such a way that it will align with our corporate objective. Not only corporate objective is to increase the NII. So apart from corporate objective, also we have to look into the condition of the market. That means market condition depends on the economic condition of the country. So what condition of the country is there? Economic condition country is there. Also you have to see what might be the future interest rates in both asset and liability. Whether interest rate scenario will be favorable to the bank or adverse to the bank, so that we can prevent undesirable mismatches or undesirable imbalances. Basically, management of balance sheet means we have to prevent the imbalances between the mix, means volume and time, as well as rate of interest, because rate of interest is the main problem. If volume and times are kept at ideal condition, the rate of interest still varies, then also there is a problem. So that controlling or managing the imbalances between the mix as well as the rate of interest of the which is prevailing rate of interest due to the economic condition of the country. If this is done, then we are doing an effective balance sheet restructuring. So our focus is to only protect the NII or NIM or enhance the NII or NIM. That is the basic thing. Okay, so this much is for tonight. Next class we'll do the rest. Any question now you can suggest, can you unmute them so that if any question is there they can ask me this.
They can unmute now. They can unmute, sir.
Okay.
As you said that fixed deposits are held for 1 year with higher interest. What is the reason for that?
You tell me what might be the reason, then I will tell you.
To attract the customers?
To attract the customers. See, basically customer will be attracted for higher interest rate only. Wherever you give higher interest, they will be happy. So why you are giving higher rate of interest for 1 year period, but not for a 2 year period? 1 year period might be 6.25%, but 2 year period comes to 5.5%. Why?
We'll not know how future the rates are going to change.
No, you tell me the reason why now the rate of interest for 1 year period is more than rate of interest for 2 year, 3 year or 5 year period. Earlier when I joined the bank, at that time 7 year period of interest was the maximum. 13% interest was paid for a 7 year deposit, which was the deposit, whoever keeping 1,000 rupees deposit, it was doubled in 7.5 years in bank deposit. I'm talking about 87 to 90, 1987 to 1990. 13% rate of interest that way. Now it has come down to 6.5, less than half of that deposit rate. So what is the reason? What is the reason?
Because the bank can hold the amount for so much long period, so rate of interest will be there.
Bank is searching for short-term
Giving loans.
No, who is deciding these rates?
Bank money.
Who is deciding? Who is deciding?
Banks.
Not banks, it is the individual bank. Okay.
Yes, sir.
Individual bank. How this deposit rate is decided?
Their cost of deposit, sir.
No, that cost of deposit or cost to deposit we have calculated, na? Cost to deposit you have calculated, na?
Correct.
Okay. So in this same, that means what? That means what? Your funds, suppose you are telling that suppose some bank will tell that for 5-year deposit I will give say 7%. Is it possible? Why it is not possible now?
Because of the high competition in the market.
High competition. So can you offer a depositor say 3-year deposit? Can you offer 7.5% now?
No, sir. Credit risk we face.
Because we are not charging higher interest on loans.
No, sir.
The honest interest rate are
Even
reducing
loans we are not
nowadays.
charging higher interest.
Because, sir, mostly loans are giving from the lower rate of interest, sir.
How much? What is your MCLR or whatever MCLR of any bank? Can you tell me?
Yeah, 7.9.
So 7.9 if it is MCLR, that means MCLR, as I told you, what are the factors taken into consider to decide MCLR in risk management? I told you. First is your cost of deposit. What is the average cost of deposit? Then your operating expenses. Then the risk thing, which is default thing. Then you have a repo into consideration. Then other things are also there. So 4 or 5 things I have told you. So these 5 parameters or 6 parameters we take. After taking this, we are arriving at say 7%. So this come to 7%, and you are finally adding a margin of 0.9%. So you are deciding your MCLR to be 7.9%. Now, if you remove this 0.9%, this 7% is your break even. This 7% is your break even. That means you cannot give any deposit rate of interest more than 7%. Just for example's sake, it might be less than that. So whatever maximum rate of interest you are offering to the public, because as somebody has told that tomorrow we do not know, for the last so many years, maybe for the 10 years period, last 10-year periods, this type of situation is prevailing in our country. We do not know that what might be the rate of interest scenario, whether it will be increasing or decreasing. Because in any developed country, you go to any developed country, you go to USA or UK, what is the rate of deposit interest they are paying to a customer? Can you tell me?
Negative.
What is it? Pardon?
2 to 3%.
Very
Max 3%. 3% is totally out of question. 2% also if they pay, that is also very good. So all the development country rate of interest has decreased like anything. So 2% is a
It's less
maximum.
than 1%.
See, less than 1% again. See, no, in some of the countries they are not paying any interest also. So same situation will come to India, because this is a trend which is going. So basically you cannot, suppose you are telling that I will pay you 7% for 3 years, means you have committed that. In between rate of interest you cannot change. So if the interest rate comes into declines in the market, you have to pay 7% to those. So maximum people will come and deposit the entire thing in 3-year period. And for 3-year period, your payment of interest is blocked totally. And if you do not earn money, then your bank will be closed. So you cannot promise for future that you cannot block them, because once you are committed, agreed for this commitment of paying 7%, you cannot back it up. You cannot reverse this thing. 7% is to be paid for a payer. This is a contract. This is a contract. Law of contract you are making with a depositor. So you cannot. That is the reason for which we are not promising anything more than that for 1-year period, because of this interest rate structure. Nothing else. Okay, so these are the complexity of asset liability management. We have to take into situation all, not only risk management, but also what will be the future rate of interest scenario. So I told you, apart from corporate objective of increasing the NII, we have to look into the economic condition of the country, future interest rate scenario. So as to that altogether, we have to decide, or the main thing is to prevent undesirable imbalances between asset and liability, or their mix of asset and liability. Mix, that means volume as well as tenure, along with rate of interest, which are charged or recovered from asset and liability. So this is what the asset liability management means. Any other question you ask? Otherwise, we'll say good night today.
Sir, can you show us the slide of the exclusion wala from liabilities? I want to take a clip of that.
I think this thing is available in your treasury management part. It is not in the, say, in the balance sheet management. This chapter of CRR is not there. I think it is available in the treasury management module.
Yes, sir. It is available in treasury management.
Yes,
Yes,
treasury
sir. Page
management
number
module.
201.
Page number 201. Thank you. Somebody is asking what is that? 201. Okay. So this is the page number. So under treasury
Thank you, sir.
management. Okay. See you in the next class.
Thank you, sir. Good night, sir.
Thank you, sir.
Good night, sir.
Thank you, sir.
Good night. Good night. Good night. Good night.